Hello students, today's topic is banking. We will learn what are banks, what are the different types of banks, what functions do banks perform, what is the role that they play in the economy. So all these things we will look one by one. Now broadly and in a very simple manner, when we are talking about banking and banks, normally what we mean is the commercial banks. That is most of us interaction is with the commercial banks. Now banking is a financial institution and its main function is accepting deposits and providing loans. These two are the basic main functions of a bank. Let's look at the different types of banks. First, what is called the central bank, that is a bank that is head of all the banks in the country. In India, we call this central bank as the Reserve Bank of India. Now, this central bank does not deal with the general public. All the banks have an account with this. It is the central bank maintains the accounts of the central government. It controls credit through what is called its monetary policy, Mudra Niti. So, and is the custodian of foreign exchange reserves. So, the central bank is the apex bank of the country. Now, come down to what are commercial banks, the banks that we normally deal with, they are commercial banks. Now, commercial banks also are a kind of financial institutions, and as I said, their operations are related to accepting deposits and providing loans. People who deposit money there can withdraw their money also. So, general public deposits money, withdraws money from there. Then these banks provide loans to businessmen or even consumers who need it for buying consumer durables or a house or anything of that sort. So, these are the basic functions of the banks. Now, as the name suggests, commercial, therefore, these banks are profit making institutions and they do business to make a profit. So, that's why they are called commercial banks. Now, among the commercial banks, there is what is called scheduled commercial banks. Now, what are scheduled commercial banks? The scheduled commercial banks, such banks are listed in the second schedule of the RBI Act 1934. So, those commercial banks listed in the second schedule of the RBI Act 1934 are called scheduled commercial banks, and these can include public sector banks, private sector banks, foreign banks, regional rural banks, and these banks, the scheduled commercial banks, they are subject to specific regulations and enjoy certain privileges. They can borrow from the RBI at the bank rate and they are members of the clearing house. The non-scheduled banks, as the name suggests, are not listed in the second schedule in that list, and they are normally or generally smaller banks and may face certain financial constraints. Then we come to cooperative banks. Now, cooperative banks are financial institutions which are owned and operated by their members, and the members are also the customers. So, remember that they are owned and operated by the members who are also the customers. The difference with commercial banks is that these banks are not driven primarily by the profit motive. Profit motive is not their primary aim, but their purpose is to provide financial services to their members. These members are often those who may not have access to traditional banking, that is the commercial banks. Then there are regional rural banks, what are called RRBs. Such banks were established in 75 basically to develop the rural economy. They provide credit for development of agriculture, trade, commerce, industry and other such productive activities that are located in the rural areas. And the clients or the members normally include small and marginal farmers, agricultural laborers, artisans and small entrepreneurs. Specialized banks. These are financial institutions that focus on specific sectors or activities. Now, these specialized banks, examples of these are Export-Import Bank of India or Exim Bank. This is specifically for international trade. It facilitates international trade. Then we have what is called SIDBI, Small Industries Development Bank of India. Its main purpose, it supports small scale businesses. Then we have National Bank for Agriculture and Rural Development, known by the acronym NABARD. This entity focuses on agricultural and rural development as its nomenclature suggests. Then we have, lastly, we have Payments Bank. These are specific types of banks that focus on facilitating financial transactions and promoting financial inclusion, primarily through digital channels. They do not offer credit related services like loans or credit cards, but they can accept deposits and provide basic banking services like saving accounts, mobile bankings. Presently, there are 6 such banks: Airtel Payments Bank, India Post Payment Banks, Fino Payments Bank, Jio Payments Bank, NSDL Payments Bank and Paytm Payment Bank. So, these are the various types of banks. Normally, what we know about banks and our interaction with the banks are in general limited to the scheduled commercial banks. But it is also important to know that there are many other types of banks that I have just told you about and the purposes for which they operate. Now, let us look at the major functions of a bank. As I stated earlier, accepting deposit is one of the major functions of the bank. The deposits are accepted, the deposits are made by the public, or it could be firms, institutions, private institutions, whatever. Now, there are different kinds of deposits. We have current account, we have a savings account, then there could be recurring deposit account and fixed deposit account. We are generally familiar with the savings account, fixed deposit account or FDs that they are called, or may be also familiar with recurring deposit accounts. Now, the second function, and which is a very important function of the bank, and the first and second functions are related, because without the first function the second function cannot take place. The second function is granting of loans and advances. These loans and advances could be made to individuals or businesses, and they can be made for various purposes. The rate of interest that is charged by the banks varies depending on the purpose and duration for which it provides a loan or an advance. Another function is transfer of funds. The bank can engage in transfer of funds on behalf of its customers. The transfer of funds could be through offline instruments such as drawing up of a banker's check, draft, letters of credit, etc. Fund transfer can also take place online, and the methods of online transfer of funds include what you call IMPS, that is immediate payment service. It's an immediate transfer of fund. Within a few seconds the fund gets transferred. The other online method is National Electronic Funds Transfer, that is NEFT, and another fund transfer method is real time gross settlement, that is RTGS. The fastest transfer of funds takes place through IMPS, next is the RTGS, and then the NEFT or NEFT. So, they perform function of transfer of funds. Withdrawal of money from the bank, of course, those who deposit money in the bank will also need to withdraw money from the bank. So, the bank also facilitates withdrawal of money by individuals from their accounts or by businesses from their accounts, and these of course can be done through banker's check, drafts, debit card, credit card, IMPS, NEFT, RTGS as mentioned earlier. Financial transactions can also be made by means of what you call UPI, Unified Payment Interface. Examples of UPI, financial transactions through UPI are is GPay, Paytm, PayPal and all these things. A bank account is essential for such transactions. Individual retirement account, that is IRA facility. This is also provided by banks. This relates to individuals who want to save money for their retirement. The IRAs provide old age securities and tax benefits to account holders. Then the bank manages investments. Portfolio management or invested related services are also provided by banks on behalf of their clients or for their clients. Bill payments. Bank also makes periodic bill payments such as electricity bill, rent, etc. through its ECS service if their clients have given a mandate for that. If the clients have given a mandate for the recurring deduction of monthly deduction of these kind of bills, the bank will be doing that on their behalf. Bank also offers locker facility to its clients. It's you can safely put your jewelry or other valuable documents into the locker. It's safe. So, to basically look at the function of the bank, the main function, the savers deposit money into the banks. This money that is deposited into the banks loans them or provides advances to the borrowers. The borrowers could be households or could be businesses. So, it is from the surplus, that is the savers that deposit money into the banks, banks provide loans from that money. Now, when the savers deposit money into the bank pays a certain interest rate depending upon the type of deposit in which the money has been put in. The savers, banks also provide the facility of withdrawing partial or full the money in their account. Now, the loans that banks gives to the borrowers, bank charges an interest rate for this facility, and the interest rate charged by banks from the borrowers will be naturally higher than the interest rate that the bank pays to the savers. Commercial banks are obviously profit making, and this is one way in which they make profits. Now, so the borrowers, though they get loans and advances from the banks, they have to pay interest payments and also repay the loan in EMIs within a certain period of time. Now, let us look at some important financial transactions that banks facilitate briefly. Deposit or withdrawal of cash, receiving or making payments, use of debit or credit card, use payment apps like Venmo, PayPal, Paytm, GPay, etc., writing a check, use of ATM, buying or renting a home. All these kinds of transactions, financial transactions, can be carried out through the bank. Now, in most countries, banks are regulated by the national government or the central bank, which is the apex bank of the countries, the central bank. In India, we call it the RBI, Reserve Bank of India. Now, banks were nationalized in 1969. A large number of banks were nationalized. About 14 major commercial banks were nationalized in 1969. Banks like Allahabad Bank, Canara Bank, United Bank of India, Punjab National Bank, Bank of India, etc., were nationalized. 14 major commercial banks in 1969, and in 1980 another 6 banks, Andhra Bank, Corporation Bank, Oriental Bank of Commerce, Punjab and Sindh Bank, etc., they were nationalized. Now, why were the banks nationalized? What is the intention or policy of the government behind nationalization of banks? Now, what nationalization means is that government takes over the ownership and control of these private banks and converts them into public sector entities. Now, the purpose of doing this is to promote financial inclusion, especially in rural areas, to promote social welfare and to promote economic development. This control of the government over the banks, it can be used to direct resources towards specific sectors. Like if the government wants to promote agriculture, it may provide or direct banks or the RBI may direct banks to provide larger advances to the agricultural sector. For that purpose, small scale industries, if the bank wants to scale to promote this sector. So, that was the purpose behind nationalization. Now, we all use money and we don't even think about the fact that how would exchange of things take place in the absence of money. We don't give it a thought, not even a single second. When money was not there, when money did not exist, how did exchange of things take place? Now, such an exchange system where money was absent, goods were exchanged for other goods. This system was called the barter system, Vastu Vinimay. Now, here the primary issue was that if you wanted to exchange, say suppose you had a extra shirt and you wanted to, and you did not have shoes. So, suppose you wanted it to exchange for shoes, then you would have to find a person who wanted a shirt and had a surplus shoe and was willing to give that to you. So this system suffered from what is the characteristic of double coincidence of wants. That is, what you want to give is what is wanted by the other person, and what you want to take is what the other person wants to give. Now, this involved searching for people who wanted the good what you want to give and who were willing to give you what you wanted. This was the biggest problem with the double coincidence of wants. Also, suppose you wanted a pair of shoes and you had say a sheep, how would the exchange take place? One sheep for one pair of shoes? There was no divisibility. So that was another issue with the barter system. There was lack of uniform measure of value. Different things were offered. How would you measure the value of them? So these were the issues that people had to face under the barter system. The discovery and evolution of money through the ages have now led to a much advanced payment system. Money has facilitated. What does money facilitate? What is the most important function of money? It is a medium of exchange. It is a universally accepted medium of exchange. Anything you want, you just have to pay its price, give the money for it, whatever its price is, and you get that. And also, money is divisible. It's not that the single unit is a rupee. You have to pay 5 rupees, 20 rupees, 35 rupees. So money is divisible. You can pay in small amounts, large amounts, whatever it is. Then money is a standard unit of account. That is, all accounts are kept in terms of are rupee dominated or rupee denominated. Okay? So money greatly facilitates transactions, and it is this fact, its universal acceptability and the fact that it is easily accepted as a medium of exchange, that allows money to lubricate the wheels of economic growth. Now, the initial evolution in the part of evolution of money, and before the digital system and other payment system came into being, the way to transfer money was through checks, bank drafts, banker's check, etc. If you had to make a personal payment to someone, you would draw a check in his name and give it to him. Now let's look at the technology in the banking system. The rapid advancement in technology has completely changed the operations of the banking system. Prior, if you remember, before this, banks had to close early because they had to reconcile their their accounts for the day's transaction and all this. But today, computers have changed all that. Computers have changed how customers use banking services, how banks operate internally, and how banks interact with the rest of the financial system. You have online banking system either through the computer and the website of the banks or through mobile. So such digital advancements have added great flexibility in banking operations, and not only flexibility but also efficiency and inclusiveness have become the characteristic of banking operations. So, let us look at some important banking services. So, banking products and services include banking deposit accounts and various types of loans and lines of credit, such as cash management, retirement accounts, checking accounts, saving accounts, certificates of deposit, money market accounts, real estate loans, installment loans, credit cards, commercial loans, construction loans, agricultural loans, etc. Large number of ways in which banks lend to different entities. Now, let us look at some banking products. One is they offer what is called savings account. The savings account an individual can open, or an entity can open a savings account. Now, this account, the interest rate is low, but it allows you great flexibility in deposit and withdrawal of money. Okay, both rich and poor people, they can easily open a savings account, and the minimum deposit requirement also is not large. This kind of account is normally popular with salaried individuals, senior citizens, students too. Okay. There are different types of savings account. One, what we call the regular savings account. This is the most common and simplest type of savings account that can be opened. To open an account, of course, you need to complete what is called a KYC, know your customer, or it can be done also electronically, hence it is called eKYC. And this savings account normally offers an interest rate of 2 to 2.5%. Another type of savings account is what is called a zero balance saving account. It can be opened without any initial deposit, and there is no requirement of maintaining any minimum average monthly balance in such accounts. However, since these kind of facilities are provided, then the zero balance saving accounts, it is natural that it would limit the number of ATM withdrawals, etc. It will not offer a checkbook facility. That is because of the nature of the zero balance saving account. Another type of account is a senior citizen savings account. As the name says, it's for citizens who are above 60 years of age. The USP of this account is that it offers privileges such as higher interest rate or lower interest on credit, etc. We have women saving account. These are specially designed saving accounts that are specially designed for women. It comes with certain privileges such as special debit cards for women, preferential loan and credit offers, discounts on lockers, etc. We can also have saving accounts for children, kids saving account. For children who are under 18 years of age, such accounts are opened by their parents or guardians. They can open such account for the children after providing for their identification, etc. These accounts, they provide regulated deposit schemes and specify spending limit so that the children, the habit of saving is encouraged in the children. A financial discipline is built in the children right from the beginning. Another kind of account is instant digital saving account. It can be opened online within a few minutes via mobile or banking application by completing the KYC procedures. Such accounts may normally have a limit to the maximum deposits, normally up to 1 lakh. Another type of account is salary account. This is mainly for salaried people whose salary are put into that account, monthly salary is put into that account. Some features of this account are free checkbook, international debit card, could be zero balance accounts, complimentary personal accidental insurance cover, preferential interest rates on loans, etc. These are some of the facilities that such an account provides. We also have a family savings account. This enables members of a family to open multiple accounts under one family identity or one family ID, and it allows the members to avail various benefits such as RD, FD, etc. Family members covered under this account are parents, spouse and children, in-laws, grandparents, grandchildren, etc. So that is how they define the family. Now, as opposed to the saving account, you have a current account. Current account are normally opened by business owners, people who need to frequently withdraw money or put money into the accounts. This account therefore is basically for business owners. Unlike the savings account, for providing this service, the bank charges some amount. It does not pay any interest on the deposits, but in fact it charges some amount for providing the services of unlimited deposits or withdrawals. And it also provides overdraft facilities, of course, by charging an interest for it. Overdraft facility allows the clients to withdraw temporarily more money than what is available in their banks. This is called an overdraft facility. We have fixed deposits. Fixed deposits are for a given period of time. It could be 6 months, 1 year, 3 years, whatever, 180 days. These they provide a higher interest rate than the savings account, and they are low risk deposits because they are with the bank. However, if you withdraw your money before the period for which the fixed deposit is done, then a certain amount of interest is deducted before your money is given back. However, they are safe and they provide a higher interest than saving deposits. Then we have recurring deposits. These are normally useful for people who have low incomes, because this enables them to put a small amount of money every month in their account, which they can easily afford. They cannot put in big sums, so they can easily afford to put some small amount into their account, into this account, ranging from say 100 rupees to 500 rupees, 500 rupees or more, and the recurring deposit can be opened for a given period, 12 months, 18 months, 24 months, depends for what purpose the individual wants to open this RD, what is his goal. So the period depends upon the purpose of the individual, he can do that. So apart from the deposits, loans are this service, the bank provides the service of providing loans and advances. This is a very important function of the bank. It is through this that the wheels of the economy are lubricated and keep moving. The whole process of credit creation the banks are involved in, and it allows the banks to give loans that are multiple times the amount of actual deposits that they hold. And this lubricates the economic wheels of the society, facilitating greater production and employment. Now, when you normally open an account, you are generally asked to make a nomination. That is, nomination means that who would get the proceeds of your account in the event of your death. So, therefore, as an informed customer, you should always make a nomination in whatever bank account you open. Then opening a bank account involves as a process of verification what is called know your customer or KYC. KYC is mandatory process for opening an account, and this process identifies the genuineness of a consumer. The consumer is genuine and the details that are given by him is a genuine person. This can be done through documents that are required for it, your identity documents that have to be produced, your Aadhaar card and other IT, PAN card and other things are required for it. Even your biometric identification, that can also happen through Aadhaar card. So, this KYC process is essential. This also prevents any kind of a fraud, money laundering, terror financing or any other kind of illegal practices. Now, you must have, if you have a bank account, you will be familiar, you have a bank passbook. It records all the transactions, whether withdrawals or deposits that you are doing into your account. Your passbook can be in a physical form and you can see it, or you can also log on to the website and see the details of your account by logging into your account. So, in the online mode. So, summing up, we see that the nature of looked at the nature and functioning of banks and the financial services that they provide. We've seen that accepting deposits and making loans and advances are the primary and most major functions of banks, and it is this that keeps the power to create credit through the reserves that are kept by the bank. That is what keeps the wheels of the economy moving. So, that's all for today, and we have finished the unit of banking. There are some keywords that you can, that is barter system, financial literacy, financial intermediation, nomination, KYC. We've discussed all these. So, that's it. Have a good day.